If you've ever traded, you know the feeling. That stop out that just makes no sense. The one that feels like the market is personally out to get you. Well, what if I told you it has almost nothing to do with your skill and everything to do with how predictable you are?
Let this sink in for a second. This is the one idea that I think changes everything. It's not about being a good or bad trader. It's about how easy you are to read.
Okay, so let's break this down. How does this trap actually work? Well, it all starts with a common myth that keeps most traders losing over and over again. The myth is that some huge institution is out there personally hunting for your tiny stop loss. The reality? Honestly, they don't care about you specifically. They care about the group. Their moves are planned, they're calculated, and they are aimed right at the spots where thousands of traders are all doing the exact same thing. Once you get this, the market stops feeling so personal. It just becomes mechanical.
So what are they actually looking for? They're looking for one thing: liquidity. Just think of liquidity as big pools of money. All those stop-loss orders, all those breakout entries just sitting there on the chart. For a big player to fill a massive order, they need to tap into these pools. Liquidity is literally the fuel that makes the market engine run.
And here's the thing, this fuel isn't just scattered everywhere. It clusters in very, very predictable places. You've got buy-side liquidity, which is all the orders resting just above recent highs. And you've got sell-side liquidity, resting just below recent lows. These are the two most obvious spots on pretty much any chart you look at.
So why? Why do these giant pools of money form in such obvious places? The answer is actually pretty simple. It's because most retail traders, well, we're all taught from the exact same playbook.
Come on, you know the rules. Buy the breakout above that big resistance level, sell the breakdown below support. And where does every textbook tell you to put your stop loss? Right, just on the other side of that level. When thousands and thousands of traders are all following that same logic, you get these dense, visible clusters of orders all in the same spots.
So let's just think about that for a second. What actually happens when everybody follows the same playbook? What does the market map start to look like when everyone's safety net is dropped in the exact same obvious location? It creates a giant, glowing target. Those clusters of orders, that huge pool of liquidity, is exactly what the big institutions need to get their own business done. Price isn't moving to these levels by accident, it's being drawn there like a magnet.
And this predictable behavior is what allows institutions to set up the trap. And it's not some random event, it's a repeatable process.
See, institutions don't just sit around and wait for this liquidity to build up. They actively help create it. They induce people to participate. That means they will literally engineer a price move into an obvious area just to encourage you to place your breakout order, to place your stop loss, essentially building up the fuel right where they need it.
It's a simple three-step dance, and it happens over and over. Step 1, price pushes into a super obvious area, inviting everyone to jump in. Step 2, the stops and the entries start to pile up, building that pool of fuel. And then, step 3, price slams the other way, using all those orders to power its real intended move.
Now, when you see this process laid out, it leads to a really crucial shift in your thinking. What feels like a personal attack on your trade isn't really manipulation. It's just a consequence. This right here explains why price often looks the most convincing, the most powerful, right before it completely falls apart. That strong-looking breakout wasn't a sign of true market strength. It was just the engine running hot on the fuel of mass participation, that inducement we were just talking about.
So yeah, traders love to call these moves manipulation. But that word implies there's some evil person trying to get you. It's way more accurate to see it as a consequence. It's the natural outcome of predictable behavior in a market that, by its very design, has to constantly seek out liquidity to function.
Okay, so if it's not manipulation but just a predictable consequence, how should we change our approach? Well, this understanding leads to a whole new way of looking at the market.
And this is the real secret. The edge that institutions have isn't that they're smarter or have some secret algorithm. It's that they can capitalize on uniformity. They don't need to guess what you, as an individual, are going to do. They just need the crowd to act like a crowd.
And that brings us to the single most important takeaway from all of this. The trap isn't the price wick that hits your stop. The real trap is the predictable thinking that made you put your stop there in the first place.
So, I'll leave you with this final thought. What if you stopped asking, where is price going to go next? And instead you started asking, where is the obvious money? Where is the crowd most likely to be trapped? That one shift in perspective, that's the foundation for trading with clarity, not with emotion.